All right. Hello, everybody. We're still waiting for you more participants to join, but I'm already going to start with my introduction. So welcome, everybody, to our today's virtual zeb.Business event, this time focusing on enabling access to digital assets. Last year, we conducted 3 online business events on digital assets and DLT, starting at the beginning of the year with the very basics and continuously progressed and went more and more into specific details of digital assets DLT, like tokenization, decentralized finance. And we ended last November with a webinar on the metaverse and what opportunities it offers for banks. For the first online business event this year, we want to go back a bit to the basics and talk about why also traditional banks should consider a digital asset offering for their clients, and what it takes to do so. So with that, I would like to give you a brief overview on the agenda and also introduce our speakers. First, my colleague Cedric Lüscher, who is the topic leader for digital assets here in Switzerland, will focus on what is the strategic rationale behind building a digital asset custody and transfer offering now for a bank. After that, we will hear from Andrew Richard what it takes to build a digital asset custody and transfer offering, and why building a platform for that is relevant. And Andrew knows what he's talking about. He's a business development executive at SDX Web3, which is a company belonging to the SIX Group here in Switzerland, and has more than 15 years of experience in the financial services industry. At SDX Web3, Andrew is responsible for sales, market development, and relationship management. So that's going to be the first part of our online event. In the second part of the event, we will focus on the crucial questions around what the risks are involved with digital asset custody and what potential risk or required risk mitigation actions are. For that, to introduce the topic around risk and risk management, before we go into the panel discussion, my colleague Julian Schmeing will focus on in his introductory notes on risk and risk mitigation actions banks have to consider when offering digital asset custody. And Julian also knows what he's talking about. He's our overall topic lead for digital assets and DLT and has done already several projects in this field. After that, we go into the main part of our online business event with a virtual podium discussion to also get the practitioner's view on digital asset risks and risk mitigation. Specifically, we want to focus on how do institutions look at digital asset risks and how can this be mitigated effectively. For that, we have Tobias Amiet from Julius Baer and Amardeep Tandi from Chain Analysis as guests on the virtual panel. Let me briefly introduce the panelists. Tobias Amiet heads the Products and Services Compliance Unit at Julius Baer and is a key person in setting up Julius Baer's digital asset program. And on the other side, you have Amardeep Tandi, who leads the Crypto and Regulatory Compliance Unit at Chain Analysis for the EMEA region. He has more than 15 years of experience in financial crime investigations, also in traditional finance. So before I hand it over to Cedric, one small administrative remark. If you wish to ask questions, please do so by using the chat function in Teams. We will read the various questions and collect them later on for the panel discussion. With that, Cedric, hand it over to you.
Thank you very much, Norman. Now, arguably, the trust in the entire DLT and also crypto space could be higher at the moment. If you look back maybe to 2022, there were actually some scandals, as you might know, revolving around FTX, around the crypto lender Celsius, and also the stablecoin Terra Luna. Maybe perceived in the media, the industry development speed has slowed down a little bit. But as a matter of fact, we at zeb are firm believers that now is really the time for builders, and especially that now is the time to build digital asset offerings when it comes to the financial industry and incumbent players in this financial industry. So why do we actually say that? Why do we believe that in the first place, setting up or enabling access to digital assets is so important? And why do we believe that it is the time to do so right now? These are the two questions that I'd like to take with us for the next couple of minutes and maybe dive a little bit deeper on those questions. So I would like to do so by maybe looking back a little bit. If you consider the entire DLT and digital assets industry and go maybe 5 years back, you could actually see that it was dominated by a lot of crypto-native companies. Crypto-native companies, obviously outside of the traditional financial industry. Financial industry players were simply not confident enough or lacked the often regulatory clarity to enter this space. However, over the course of the past, let's say 12 to 18, maybe 24 months, this has changed entirely. All over Europe, and especially also Switzerland, a lot of regulatory frameworks have been put into place, which now, as said before, allow financial institutions to enter this place. Let's, for instance, here think about the DLT Act in Switzerland, which not only regulates the term of digital assets, but also puts into place certain rules and guidance when it comes to DLT market infrastructure. This is obviously, on the one hand, regulatory guidance for financial institutions, but also sets new standards for regulatory requirements, obviously making it harder for the crypto-native companies to sustain in this area. With now the new entrance of a lot of financial institutions, perceivedly also the entire focus of the work in the industry has changed. While at the beginning, the focus was really quite often on crypto-native use cases. Let's here think about crypto brokerage, maybe also staking and so on. What you hear about these days is really about asset tokenization and making accessible also certain efficiency gains through the means of tokenization. And that's obviously where it gets really interesting for financial institutions. As a matter of fact, we at zeb believe that by 2030, the market for tokenized assets in Europe could reach up to 3.1 trillion euros in the EU and also Switzerland. So quite an incentive for incumbent banks and other financial institutions to enter the space. But of course, if these players would like to benefit from that, they also have to start creating the necessary infrastructure right now. What is needed right now is ultimately infrastructure for the safe issuance, but also custody and management of digital assets. So what it is at the center stage is really custody and asset transfers right now. And well, if you have that, you can then also think about more advanced use cases. If we go to the next slide, next page, we can, for instance, then think about the tokenization of real-world assets, such as commodities, collectibles, one can think about art and so on, but obviously also about the tokenization of infrastructure, maybe even solar panels and so on. What is, I guess, quite interesting also for incumbent players is the tokenization of securities. Obviously, here we can think about DLT stocks, for instance, when it comes to the tokenization in the area of small and medium enterprises, the tokenization of bonds, and also, for instance, fund shares. So also the asset servicing industry seems to be at the moment quite an interesting space. Of course, these are not the only use cases that are enabled by digital assets custody and transfers. One can still think about all the crypto-native use cases such as staking and so on. But what is driving the industry right now is obviously tokenization. So let's maybe step back a little bit and consider the principle of DLT and digital assets in the first place. Now, isn't it the case that at the very center stage, DLT should create a decentralized world without having the need for intermediaries such as a bank? Well, that may be true, but there is actually a case also for banks. There seems to be a place for banks also in this future world. Because ultimately, what we have seen over the last couple of months is that there is, maybe if we go to the next page, that there is really a high need for a professional setup in the entire space. DLT transactions and also the handling of digital assets involves highly complex processes if you simply only consider these pseudonymous transactions that happen via blockchains. You have alphanumeric strings which enable transactions, so from one player to another. And I guess this is exactly where you don't have any room for error and where a professional setup with the required security steps and protocols is really needed. And out of their history, obviously, this is exactly what banks could offer and where they can also, I guess, take a leading role in the future. Apart from this first reason, obviously, also historically, banks have shown a long track record of safeguarding assets securely. And again, now reflecting on what happened last year, there seems to be really a strong need in the entire crypto industry and digital assets industry to have a clear split between exchange trading activities and then also custody activities. So again, showcasing another reason for banks having a role in this entire system. Now, last but not least, if you think now about an institutional setup, there are also simply cases where you do need, by regulation, a licensed player to take over the role as a custodian, and thus also the role of someone being able to handle and transfer digital assets. Let's now consider, for instance, asset servicing or the funds business, where you simply need to have a depository with a certain license, and thus you need to go into the regulated space anyhow. Now, once you have decided, and once we actually see that obviously banks should start with DLT, digital assets, here obviously custody and asset transfers, obviously the question arises, how can you actually do it? How can a bank implement such an offering? In the next couple of minutes for my last part, and then also for the presentation of Andrew Wishart of SDX, we're going to focus exactly on this question. From our point of view, from the point of view of zeb and also the lot of projects that we have done in the past, there are 4 key success factors when it comes to implementing digital assets custody and also transfers. Given the complexity and also the risks that are involved, there really needs to be a strategic push with a lot of management support when it comes to starting the entire initiative and digital assets program. If you don't have that, you will end up in a lot of discussions, for instance, between the business units and also the CRO area, where risks may be perceived skewedly. Secondly and thirdly, you need to very early on start educating not only your staff, but then also clients, so that out of the proper understanding of the risks and complexity in the area, you can start to implement a sound risk management and sound risk mitigation measures. We will obviously cover that also in our second part of today's event, with, on the one hand, the presentation of Julian from zeb and then our 2 guest panelists. Fourthly, and this is the last reason that we have seen, given the entire dynamic in the industry and also the fact that maybe technological protocols and regulations change quite often still, you also need to approach the entire topic with a certain degree of flexibility. So, for instance, when you set up your technical platform, I guess it's important to always be able to plug and play, so plug and replace certain aspects of it. Now, having seen all this and knowing a little bit what the success factors are, I would now like to hand over to Andrew Wishart of STX, who is going to give us the practitioner's view and also explain us a little bit how, for instance, STX Web3 can help a bank come up with their own digital assets custody and transfer offering. Andrew, handing over to you.
Thanks a lot, Cedric, and also thank you, zeb, for having me today. Much appreciated. And obviously, I'm also echoing a lot of things that you've just outlined in your introduction. So I can only echo a lot of what you said, and I'm going to try and go deeper in my presentation as to how these things really are relevant for banks and securities firms and others to plan out their digital asset foundation custody plans, but obviously their broader digital asset strategy from there. Just briefly introducing STX and Web3 services in the beginning, just so you're aware of what we do and how we're structured. And then we're going to touch on challenges that specifically around custody you need to take into consideration, but also other challenges that pivot off the custody into how these assets sort of access liquidity, for example, in the broader universe. Then our custody offering, I'm going to introduce how we've structured that, what the nuances are, but what we had to consider. So hopefully that's helpful for the audience. And then maybe touch on an example of how we at STX are sort of trying to also tie in parts of our broader 6 value chain to offer value propositions and help the transition into digital assets more broadly. And then obviously Q&A at the end. Hopefully we have time for that. If we just move on to the next slide, unless I can take control, actually, I think that works. Excellent. We at STX have a 3 kind of pillar strategy that we're driving at the moment. We started in the digital securities area and arena, where we created a regulated CSD and a regulated exchange venue for digital assets. I should probably call it a DSD, really, as it is distributed, and that is actually the piece that is using the new technology, distributed ledger technology, on the DSD layer, where we offer access to digital and the opportunity for our members to tokenize native digital assets. So they're intermediated securities natively issued onto a DLT infrastructure, and thereby natively digital assets, bonds or debt instruments and equities. And we've built out a private equity, let's say, marketplace, which allows, given that this is a traditionally paper-based kind of environment of the equity infrastructure, which doesn't have a lot of native digital infrastructure built for it, we have developed a marketplace for that, in order for that kind of marketplace to also flourish. Additionally, we've also got tokenized Swiss franc, so a digital Swiss franc and a digital euro on the platform, which obviously helps in the settlement of these securities transactions. And that's something that is not so easy to do, given there are no real central bank digital currencies available yet, and may not necessarily in certain forms be available for some time. And so with that, we've set out our initial roadmap on the securities landscape. The second pillar, I'll just continue speaking because I can't see the slides at the moment. The Web3 business was really brought into life in order for us to provide banks and securities firms and other profiles public blockchain infrastructure access. That means that foundationally we built out a custody infrastructure, but we're also running other types of blockchain infrastructure or auxiliary components to that, like running nodes as a service for staking, so running validator nodes, which we've also connected to our custody infrastructure for custodial staking. And we're also building out access to liquidity venues, and this focus first and foremost on cryptocurrencies at this point. However, which we'll come to on the next slide, also touches the digital securities space that are, however, issued on public blockchains. Then our third pillar is just more to explore the non-traditional asset space. So, for example, NFTs have come into the foray. Generative art, for example, is a growing kind of market that we may think banks might want to offer safekeeping for their customers that are into those kind of new types of assets. But also when it comes to tokenization of collectibles, or be it even real estate, and also carbon credits. These are areas that we're exploring, and that will then feed into the two business divisions, either digital securities or Web3, depending on how it fits. We just move on to the next slide, please. So this is more a little bit about how we see what our starting point was and how we see it developing when it comes to the DLT and broader public blockchain space. So we started our digital securities business on a permissioned chain, because given at the time when we started this, first of all, there was not the DLT license available. So we actually moved forward with traditional licenses, but also back then, permissionless public blockchains weren't at the maturity level as they are now. So we set out to run on a permissioned chain for that. However, what we've basically been witnessing over the last 3 to 4 years is that the public blockchain space is really maturing. Now, it may not at this point be fully mature to be used for a full FMI infrastructure, but it is showing signs of components that are being weaved into these chains that could be used for certain financial market infrastructure areas and types of assets. Starting obviously with cryptocurrencies, which obviously most of you are well familiar with, but also NFTs, and now interesting kind of marketplaces in the decentralized financial world. We're sort of seeing that this is an important part of maturity, which now needs to be taken serious when it comes to actually utilizing it for actual financial market infrastructure. Baseline to that, of course, is custody, which we'll talk about more depthful in a minute. But our view is that these two pieces of permissioned instances of public blockchains will basically allow digital securities that have been in a regulated environment, for example, and a public blockchain, that these parts, they will converge together in the future. And in some cases, we've seen now, for example, with Project Guardian, that forked versions of public blockchains are being used to do real digital security settlement transactions. So that's a space to watch, and something that we believe strongly in, and which is why we've got our Web3 services business to help us then integrate that into our regulated marketplace going forward. Can we move to the next slide, please? Great. So I'm going to focus here really on the challenges that we see, and mainly focusing on the left-hand side, which is talking about the custody component. So first and foremost, I think what's really important to outline is that when you're doing digital asset custody, which obviously is underpinned by safeguarding private keys, which are then the access vector to the assets, you can actually lose things in digital assets, in the digital asset space, very specifically also when it comes to cryptocurrencies. And this is what Cedric also mentioned earlier when it comes to the risk vectors that you need to consider here. It is extremely important to understand what risks you're taking when you're offering custody of digital assets. Now, we have, for example, when it comes to the public blockchain safeguarding of assets, created a 5-layer of defense model, which I'll talk to you later about. But this really is sort of foundational to bear in mind, which can also make you consider when you're making the decision around what kind of a custody setup you want to run is, do you want to run your own custody solution yourself, or do you want to work with a sub-custodian? Now, obviously, in our particular, I would say, positioning, we think that certainly for cryptocurrencies, we would like to be able to be that go-to point for offering sub-custodian services, because specifically around cryptocurrencies, that's where you can really lose the value, and that's where the risk is much higher. Whereas when it comes to digital securities, depending on how they are issued, they can obviously also be recovered despite being on a public blockchain. So there, for example, we foresee that there will be a multi-custody approach that most players will take, certainly larger banks, for example. We ourselves also will be working with multiple custody solutions going forward for redundancy purposes and the like. In any case, I'll just move over to the other challenges, as we'll talk a little bit more deeply about the custody in a minute. One of the other challenges that you'll find is, especially in the cryptocurrency market, is that it's a very, I would say, fragmented, unregulated liquidity market. And we obviously saw different challenges that occurred around the collapses of the likes of FTX, where clearly not only were they maybe not operating in an institutional capacity when it came to sort of their best business practices and operational kind of processes, but it also highlighted the risks that you run when you're basically not considering counterparty risk and separating asset custody from trading. Now, counterparty risk is something that never really disappeared, but for some reason in crypto, it sort of became slightly underestimated, mainly because it's also a retail-driven market, or initially was a retail-driven market. But I think now even retailers are fully aware of counterparty risk. And this is something that now we're hearing more and more when exchanges are even approaching us to enable access vectors to their exchange and using tri-party collateral management setups in order to effectively not have the customer need to pre-fund with them, but seamlessly be able to trade at their venues. Currently, this is a development process for the market structure. So the old market structure still behaves a little bit like an FX market from 20 years ago. But I think now, specifically this year, and we have seen some announcement recently of these kind of setups whereby the custody and the venue are really separated, but are somewhat interlinked. But the real challenge is obviously the post-trade handling of all of this, which I'll keep short because I know we need to move on to the custody topic. But as I've left Silvergate and Signature on here, that previously with the US dollar de facto hubs, the liquidity and again, the way that one on-ramps and off-ramps and deals with 24/7 in cryptocurrency markets is something that still doesn't have, there's no silver bullet solution to this at the moment, but that's something that we're, for example, trying to work towards in order to seamlessly facilitate 24/7 with native on-chain fiat for the time being. If we just move on to the next slide, please. So maybe just explaining it on the basis of how we've set up our custody solution. So we're a custodian in our setup, and we, as SDX Web3, are operating the layer 1 instance, which is the central pillar on the slide. Here, we're securing the private keys and therefore the assets in what we call hot and cold storage. And obviously, we're also facilitating the different idiosyncratic blockchain asset servicing components, be it airdrops, etc. We need to be able to handle that on the layer 1. And also, we clearly are also monitoring the transactions, and we're also part of the signing procedure when it comes to certain large value transactions, and also whitelisting venues for external transfers, or also vetting incoming transfers, which is what you see a little bit on the right-hand pillar, which is external to our infrastructure. On the left-hand side, what you see is the reporting layer, which you could call a layer 2. There, the customer themselves on our platform are able to set up their account structures, which also, by the way, can be done in an omnibus setup, but also you can segregate on-chain wallets. If, for example, you in private banking have customers with particular requirements that want to have an isolated on-chain segregated holding of their assets. But additionally, we, with this setup, are able to either through a user interface or through reporting in Swift standards, which is mainly targeted at obviously banks or securities firms with BICs, in order to simplify and initially cater for getting this information into their traditional banking infrastructure. Because it is not necessarily something that's going to happen from day one until every bank runs their own, let's say, custody solution and has maybe upgraded their core banking systems to be able to natively read out of the chain, for example. We will need to take these interim steps at first to simplify reporting. So that's what our solution is really targeting. The next slide, please. Thank you. So what we have done to just deepen the conversation about what you need to consider when you're selecting your strategy for providing digital asset custody is we've developed something that we've called the 5 layers of defense, which we've sort of broken down into different important components as to how we think about protecting our customers' digital assets. So the first layer is the business layer, which, being part of a FMI group, we need to adhere to stringent policies that as being part of that consolidated supervision under FINMA, in order to adhere to highest level of standards around business processes and operational processes. So this could include segregation of duties, no same person is involved in whitelisting addresses, who's then involved in signing transactions and so forth. This really is fundamental to having a sound business setup. The second layer of defense is the actual security around the technical infrastructure, so cybersecurity, but also the way the custody solution is implemented and set up. So what we have done is we have basically created a on-prem setup. We use Fireblocks. And Fireblocks, as many of you may know, use multi-party computation, meaning that the key shards, so the private keys split into 3 shards, and they in themselves are now geographically remote from one another, safe kept in 6 data centers in HSMs. So we're basically combining MPC technology and HSM technology to safeguard the private keys in highly secure FMI data centers, alongside all the procedures that we have in those data centers, but also for our solution around enterprise pen testing and also disaster recovery. So if for whatever reason our solution, and this is why I also mentioned earlier that we will likely move into a secondary custody solution, is that if one fails over, then it can go into the other solution in order to continue operating. The third layer of defense is risk, which sort of tightly links to what I mentioned in the layer 1, but is more sort of specifically around internal control processes and other risk and control points. So this is really important if you're looking to offer institutional grade kind of custody. These are all the things that, for example, weren't in place with FTX, for example. I believe they held private keys and shared mailboxes and all the rest of it. That clearly wouldn't pass our internal control security process. But very importantly also our audits, that the infrastructure is always vetted annually and appropriately certified. We had an Ernst & Young audit where the person in charge and involved actually built several custody solutions himself, and therefore was very depthly knowledgeable about, you know, what the risk vectors are, and therefore we also got very important and valuable feedback that helped us really robust our setup. And as it evolves and further audits take place, we will continuously be able to improve our solution as it moves along. And last but not least, there's insurance considerations. You can't insure everything when it comes specifically to cryptocurrencies. It's become quite expensive, and some things are prohibitively expensive. So that's why the first 4 layers are of such importance, because you're not going to be able to insure everything, at least not without it being commercially unviable. We have decided to do an event-based insurance setup, so basically internal and external fraud up to certain threshold amounts per event. So this is on a sliding scale. So while we've noted 5 to 10 million here at the moment, this will potentially increase. But we've broken down the capability to transact in line or synchronized to the amount that is covered, so that if in one event there is an occurrence of fraud, that then of course you wouldn't have been transferring more than could have been covered by the insurance. We also have additional insurance coverage options that we create bespoke for our customers, but the standard setup is the one I've just outlined. Move to the next slide, please. Thank you. So I'm just highlighting a little bit just as an example to you, sort of how our roadmap evolved. So initially, of course, we had to set up sort of the foundational custody, and I think business hours are something that are really important to consider. So currently we operate only during normal business hours, which obviously in cryptocurrencies can be quite challenging given it's a 24/7 market. So those are the kind of things that going forward you're going to have to deeply consider as well when it comes to having weekend staff, how you automate into a 7/24 setup. Those are definite cost challenges that you're going to have to consider. Then, of course, when it comes to the reporting, we've sort of obviously introduced different ordering and reporting standards that clearly, because we're in the B2B capacity, trying to report back to banks and securities firms, that's an important component that we needed to integrate. One of the key things that which is linking how we kind of connect with the broader SIX value chain, is the collateral management support. So here we use SIX Repo as a tri-party agent that have access to our collateral accounts, or rather a customer's collateral account, if they want to use crypto, for example, as either margin collateral or underpin, for example, an ETP, and have a neutral party able to report at all times that the product is at all times collateralized by the crypto itself. So those are kind of pieces that we're stringing into our overall setup. And then maybe integrating our staking infrastructure into the custody is also something that if, for example, you want to run your own validator nodes, or you want to work with a partner but integrate them into your custody solution, there are different types of setup of custodial and non-custodial staking that you can consider, but they have different pros and cons, especially when it comes to security. Moving on to the next slide. So as I said, I didn't want to make this come across as a sales pitch, but what I would say is, rather than what should you consider when going for your custody strategy? So first and foremost, what do most incumbents really think about, like the business case has to stack up, and that also involves how much will this cost me? Now, as I said earlier, there are, as you saw in the 5 layers defense, there are a lot of non-technical components that you need to consider. You need to be set up from an operational standpoint to be able to run a custody infrastructure, which has nuances and differences to the traditional custody world. Then you also need to consider the specialized knowledge that you might have to acquire in order to run your own custody solution, which meanwhile is becoming quite expensive in the marketplace, and also not readily available at all times. So that's another challenge that you need to consider. Obviously, the cost around audit and certifications, and also what I mentioned earlier, the insurance piece. So this is really very, in other words, it's not cheap to run a digital asset custody solution oneself. So, and it also depends what you want to run it for. The risks go up if you're doing it for cryptocurrencies, if you're doing it for tokenization purposes, for digital assets. Obviously, at the moment, that's the developing market. So again, there you would want to consider the timing of when you want to do a custody solution versus doing it in a sub-custodian model, which will also allow you to tokenize without being full control of the custody solution yourself. So it really depends on the size of the bank and the use cases that the bank or securities firm wants to run, and that will then, you know, help determine what the best direction to go is. When it comes to our, let's say, other aspects, I mentioned the security part. Obviously, the Swissness here is just really referring to that all key shards are held in Swiss data centers, which, you know, can be very important to some, specifically banks that don't want to have their key shards held either in Israel or in the US or other parts of the world that they don't feel comfortable with. In our setup, we just really ensure that we can fulfill that requirement specifically of the Swiss marketplace to have everything, all the assets secured in Switzerland. And then lastly, the integration that I mentioned earlier doesn't just only relate to the collateral setup, but also sort of kind of mirrors back into our vision as to the convergence of public blockchains for regulated marketplaces, that we will then be able to integrate our Web3 custody infrastructure into a regulated CSD, or a DSD, or maybe just directly to the marketplace and exchange itself. I think these market structures are actually still developing, and it's not fully clear how that long-term will pan out, but we're positioning in order to be part of that and help shape it. So with that being said, I think we'll just go to the last slide. I'm slightly maybe running over, so apologies for that. This is just an example as to how we're stringing together the 6 value chain. So SDX Web3 offering custody and also staking infrastructure, which for example, product issuers, we're seeing that a lot of product issuers are now trying to create actively managed index products around cryptocurrencies in order to offer their customers some simplified access and exposure to yield and various protocols. And in order to do that, let's say institutionally, we feel that having this tri-party collateral control setup, whereby a customer can not only then allow a tri-party agent to block and at all times prove that the product is collateralized with what it says it is, or cross-collateralize if a customer wants to go that far, but then create the security, which then ultimately gets listed on either the traditional exchange or even the native digital exchange, and thereby sort of creating a one-stop shop value chain for participants. This is a very interesting way to string, let's say, TradFi principles with the new age technology together, and something that we're finding a lot of interest in the marketplace from. So I just wanted to share that with you if that's something that you also might want to either develop yourself or be interested in talking to us about. Now, I think at that point, I'd like to stop and want to thank you for your time, and I look forward to any questions if we have time for that. And here are my contact details.
Thanks a lot, Andrew, for giving us all these interesting insights into the SDX Web3 strategy and also platform. Since we're a little bit over the time, I suggest that we don't take questions for you right now, but go to the next speaker and then try to add in questions that came up during your presentation. during the panel discussion. You also mentioned on various topics that touched risks, and that's going to be the focus of the second part here of the presentations, where Julian Schmaling is going to do an introduction on risk and risk mitigation. And after that, we go straight into the panel discussion. So, Julian, can I ask you to take over, please?
Yes, sure. Thank you so much for the introduction and for the presentation, Andrew. Because we are a little bit late in the schedule, I keep my words quite short, because you already mentioned several risk components in terms of digital assets, business models, and digital assets transfers, and then custody solutions. And I just would like to set the theme for the later discussion, panel discussion, and give you an overview of the relevant risks we would like to discuss. So first of all, when we're talking about blockchain transactions or DLT transactions in general, we have one major issue, and which is that you do not transfer assets or token from one person to another. You transfer it from alphanumeric strings to another. And with this setup, which is basically the key component of each and every blockchain transaction, is that it's not easy to identify for banks or financial institutions who is standing behind which string. And it is not so. It is an additional effort and processes which are not well established in banks to get through these numbers and figures to check out, is this wallet or this person behind that string really trustworthy, and can I do business with these people or institutions? And given that fact of a blockchain transaction, there are risks arising for banks and financial institutions. When we go on the next slides, we covered basically two types of risks. There are numerous risks in digital assets environment, but we would like to point out two specific risks we would like to discuss later on in the panel discussion. So first of all, as I mentioned, digital assets transfers require completely new approaches in terms of money laundering and terrorist financing, for example, because you do not know who is standing behind which wallet. And you have to make sure, as a bank, that first of all, the wallets you are trading with are so-called whitelisted, and it's not they are not used in terms of AML of money laundering, and they are not related to terrorist financing, for example. And you have to make sure that the coins which are transferred are not used by criminals before in the value chain. So you have to implement certain measures which are completely new for each and every bank, because the policies and procedures we need in these blockchain environments are not implemented yet. And on the other side, we are talking very much about digital assets custody. Andrew gave us an overview of all the risk measures and layers related to digital assets custody. And in fact, it is a very complex system which banks have to implement or will use services from other legal entities in terms of securing private keys. And for example, risk arising there is losing the access for wallets. So if you do not have any access to your wallets, you might lose all your assets, because the whole infrastructure is not comparable to traditional custody solutions. And as I said, it's very complex in terms of the technical setup, because from my experience, the blockchain infrastructure has to be connected to banks' legacy systems, and you need other skill profiles, programmers, and people in the bank to cover all types of risks and technical issues in the new blockchain environment. But nevertheless, there are risks arising from digital asset business models, but there are also some measures already in place. So banks can really cope with the new risks, and they are able to set up certain measures to mitigate these risks. On the one side, as I said, there are already forensic analysis tools available on the market which check for you the involved wallets and transactions behind a certain asset transfer or trade. So they can give you a so-called trust score back, and you can identify is that are these counterparties worth trading with, and can I accept in my custody solution these certain private keys? And on the other side, also the regulator is really pushing that direction in the implementation of the FATF travel rule that the bank is required to identify who is standing behind which wallet, and the whole trading chain from the investor and the issuer is completely transparent in terms of tokenized assets and digital assets in general. And also the digital assets custody setup is there is a certain market standard. For example, the multi-party computing setup with different signatures from and 4i control procedures in banks and in these specific systems. For example, you name it, Fireblocks, Mitaco, which are quite common in the market. Andrew already told us, and another risk mitigation measures could be the transfer from hot to cold storage. So the hot wallets are connected to the blockchain, and cold wallets are completely on a ledger and not combined with, not connected to the internet. So this will really secure the assets from attacks from outside of your custody solution, for example. So there, to sum up, there are already measures in place, and I'm really curious about the panel discussion, how these players currently interact with these risks, and which measures are already implemented, and what are the lessons learned of specific projects in the market.
All right, well, thank you very much, Julian, for this brief introduction on digital assets risk and also first risk mitigation measures. It is now my very pleasure to welcome, on the one hand, Tobias Amiet from Julius Baer, and on the other hand, Amardeep Thandi from Chainalysis, both experienced practitioners when it comes to handling digital assets. As we've heard, Tobias Amiet is one of the key figures when it comes to implementing Julius Baer's digital assets ambitions, while also Amardeep from Chainalysis obviously is one of the key persons when it comes to bringing their solution for forensic tools and so on into the market. Welcome, Tobias and Amardeep. Maybe to start off our panel discussion, could you now directed towards Tobias, share a little bit how you came to enter the digital asset space, and also what Julius Baer's approach towards digital assets custody and transfers is?
Oh, thank you very much, Cedric, for having me. We, JB here at, we started our endeavors in the digital asset space in 2018. Where our BOD and EXP came to the conclusion that digital assets is a new asset class, emerging one, here to stay. At the time, the decision was taken to enter into a financial investment into zeb, which was one of the upcoming crypto banks in the crypto valley in Zug. We acquired a financial stake, and in parallel, we drew up a cooperation agreement with them on brokerage as well as custody. And we also accompanied them in 2019 during the process, during their process to get the banking license which was for us one of the quality signs, let's say, to consider also for brokerage and custody services, which we then offer to our clients. That means SEBA Bank in the meantime, because they got their license in 2019, is both our executing broker, but as well as our sub-custodian.
Okay, so if I understand it correctly, you yourself, you also grew a little bit into this position, grew with the entire industry, but also mainly through the entire SEBA investment of Julius Baer. Well, very interesting. Now, switching over to our second panelist, Amardeep. You are now working at one of the leading digital asset forensics providers. Can you maybe also share with us a little bit how you switched your career from traditional finance and came to work in, well, this emerging player, or at this emerging player?
Thank you, and good afternoon, everyone. Thank you for having me. So yeah, just to touch on, so my background is actually in digital forensics, so probably not too uncommon in this space. And initially, I worked for law enforcement and government. I then went into the consulting world over a decade ago, where I joined EY. I think on the previous talks, I think you heard that EY do certain audits and so forth in the digital asset space. But I was predominantly involved in leading the financial crime-related investigations there. So typically regulatory enforcement actions on banks across Europe, Middle East, and Africa. And then the digital asset part of my journey really started in, I think it was around about 2013 when one of my colleagues came to me saying that his friend or his friends were mining something called Ethereum and making some money from it. And my first thought was, is this some type of mineral that they're mining, or what's happening here? Like, I didn't really understand or what was happening. And so I said, what is this? And he said, no, it's a cryptocurrency like Bitcoin. And this really sparked my interest. So I started reading, the Bitcoin white paper, the Ethereum white paper, and so forth. And then I was absolutely amazed by the concept of distributed ledger technology and more so on smart contracts. And I thought there's definitely going to be some big future when it comes to smart contracts. So I then started building kind of mining rigs and nodes and testing it myself, being kind of a hands-on forensics, digital forensics investigator. And I thought the best way to really learn is to immerse yourself in the technology and build things and see how really it works. And that's where then I got brought in with my knowledge into EY's global blockchain team. So, helping develop solutions and services in the crypto and blockchain space. And in EY, we actually, in the very early days, we built our own blockchain analyzer tool, which is very similar to some of these blockchain analytics forensics tools that you have either in Chainalysis and our competitors. And then kind of I went on then to lead crypto and blockchain services at other consulting firms before being approached by Chainalysis. So I've been really fortunate to use kind of all manner of blockchain analytics products from across, the different companies in this space.
Well, that definitely sounds like quite a lot of experience on your end when it comes to DLT and digital assets. Very impressive. Amardeep, maybe just a short side note, your camera is still off. Now let's switch to the key risks obviously involved to digital assets. Julian has given us a short outline beforehand. Maybe also looking at Tobias first. I mean, some market participants inherently see a huge risk within digital assets and still don't really understand why it's so important to actually enter this space. They believe, well, too risky, you can't really mitigate the risks involved. How is it that you at Julius Baer still entered, and how do you believe, or what do you believe are the key risks, first of all, that are involved?
Yeah, in custody we learned, I think, also from the presentation held by the STX colleagues, right? You have numerous risks, primarily operational risks, but you can address those. As you might understand, given that JB is also a regulated and prudentially supervised bank, we have to evidence that we entail sufficient due diligence on our brokers, but also on our sub-custodians. Therefore, one of the risk mitigation measures is, of course, that you perform sufficient due diligence. We do that via our regular standardized processes, also similar to our securities or financial instrument sub-custodians via our global network management. So we have regular on-site visits jointly with experts from IT, from information security, from legal compliance, operations, trading colleagues, which perform on-site due diligence. We also get annually a copy of an audit report, which is also performed by an external audit firm, unfortunately not by EY, but by a competitor of EY. However, they also certify that their risk procedures and risk controls are adequate. They are also ESOI standard, they apply on it. And we also were asked by our Chief Risk Officer to perform a so-called tail legal key risk assessment, because he feared that obviously there is still some leftover risks, given that the DLT law in Switzerland in particular, and the respective adoptions in the bankruptcy law in Switzerland was never yet before, never tested before a court in Switzerland yet, luckily, given that none of the crypto banks defaulted. However, we also performed this exercise. And what is also crucial there, a very important risk mitigation measure, that you have really bulletproof contracts in place on the custody side, on the brokerage side, on the corporation side, and that you mirror all relevant clauses, including but not limited to the liability clauses, also contractually and equally, if at all possible, with your clients. So that's a very important aspect, also a risk mitigation aspect, not to be forgotten. In case of any kind of complaints or any kind of operational incidents, it's really crucial that you have this in place.
Okay, that's impressive. Now you quickly touched upon these, let's call it tail risks, and also the fact that maybe some of the DLT Act in Switzerland hasn't really been proven in front of a court. Can you elaborate a little bit quickly on these tail risks? So what would such tail risks include? I mean, we've heard about, money laundering, and also terror financing. I think we can talk about that in a second with Amardeep, but what are the tail risks that are relevant to you?
Yeah, I think your SEB colleague already outlined some of them. You have internal and external fraud risk scenarios, right, which you have to consider. And those risks, those tail risk, as mentioned, you can mitigate with regular audits, on-site visits, expert exchange, and mirroring it contractually, passing on some of the liability risks contractually back actually to the custodian, which then has to properly cover those with insurance coverage, which we also to some extent do on our end. However, with our insurance company, for example, there is not yet a tailored or a specific offering for crypto coverage. So you have to bear all those factors in. We also saw that there are additional tail risks which have to be considered, as just recently, given the issues that the dollar clearer had, Silvergate and Signature Bank, which also affect indirectly or directly the crypto world, given that a lot of those crypto counterparties banked with those two clearers. So you also have to consider these kind of tail risks in your scenario, because if your custodian loses the dollar clearer, then obviously your services towards your clients are also restricted or limited. And you have to perform on all processes a proper due diligence, also on the delivery side. So we drew up specific processes on the delivery in and out side with our sub-custodian. And we wanted to ensure that there is proper crypto forensics being performed in and out. Our crypto currency sub-custodian zeb Bank works with chain analysis. That's not a secret. So they heavily rely on the crypto forensics capabilities from chain analysis, which is a very reputable firm in that space. This was also important to us, you know, that it's a renowned, reputable crypto forensic provider, which then supports our sub-custodian in performing these kind of background checks.
Well, thank you very much. I guess that is also a nice way to now switch over to Amardeep. Now, obviously, I guess when it comes to digital asset transfers, that's also when you start to think about crypto forensics. So checks about the taintedness of both wallets and transactions. Can you elaborate for the audience today how a firm such as Chainalysis operates and why, in the end, such forensic checks are so important?
Yeah, thank you very much. You know, and obviously Tobias for your kind words as well. So I think, you know, when it comes to Chainalysis, what I'll probably start with is just explain, I won't go into too much detail, but explain exactly how we kind of relate these wallet addresses or alphanumerical strings to real world entities and services. So really what we do as a business or as a core business is we effectively de-anonymize the public blockchain network to a certain extent. And we do this by some very complex heuristics, web scraping, and also a forensic breakthrough called address clustering, which really is the breakthrough that occurred many years ago that allowed us to then associate a group of these alphanumerical strings or public keys together to associate that with a real world entity, such as a crypto exchange, for example, or a business. And so really what we're doing then is we are effectively, you know, able to identify real world entities or businesses that obviously, you know, have a number of wallet addresses, but we're also, you know, through our complex heuristics, analytics, and a huge team that manually verify each of these attributions, can categorize these services. So what I mean by categorizing, I think we've touched on sanctions, potentially AML compliance, but we can relate these real world entities to whether it's a darknet marketplace, you know, like Silk Road, for example, whether it's, you know, a money laundering a mixing service, for example. So some of the ones recently that have been sanctioned, you know, by OFAC, such as Tornado Cash. But we can also look at kind of gambling sites and crypto ATMs and so forth. And this categorization allows businesses really to, you know, to build these rules. And what I mean by that is your compliance, you know, thresholds and checks. And so we as a business then have, from that underlying data lake that we sit on, are able to provide a whole host of solutions for both public and private sector. And so for banks and for financial institutions and for you know, crypto native businesses, what we are able to do is provide third-party or counterparty monitoring solutions that allow you to look into these entities. So if you are a bank now looking to start a commercial relationship with Coinbase, for example, or any exchange, you can actually type that into our solution and actually see what's happening on chain in terms of digital assets going in and digital assets going out of these organizations, and then compare that to regulated entities, more riskier entities, to see whether or not the on-chain activity that you're observing fits the risk appetite of your business. And also, as I think Tobias mentioned as well, when you are in a position where you're starting to custody and taking in crypto assets and obviously allowing your clients to send them out as well, you need some form of real-time monitoring. Typically, like what happens in TradFi, is a whole host of real-time monitoring solutions in their tech stack, such as Actimize, for example, Thomson Reuters, and so forth, for adverse media checks. And so we allow you to do real-time monitoring of cryptocurrency coming into your business and where it's going out. And what that allows you to do is understand what type of categories are coming in. So whether they're illicit actors, from scams sending money into your business and so forth. So it allows you to build thresholds within your organization, very similar to how the real time transaction monitoring works in a bank for fiat currencies. We then have an investigative tool that allows you to really dive in deeper. So once you've established certain rules, like if any crypto with a sanctions exposure comes into our business, we basically need to either freeze or we need to look into that, and that gets alerted to the compliance analyst team. They can then go in, have a look, and they use our investigative tool then to deep dive into the transactions and see who's involved with that, which then would allow you to kind of support your activities when creating a suspicious activity report or a SAR, for example. So that's kind of quite I'd say the majority of our solutions there. But we also do have other kind of use cases for these solutions. So that investigative tool, for example, can also be used for a source of wealth check. So if someone comes to your bank from a retail banking perspective and says, right, I've got 100,000 euros to put into your bank, and say, where do you get it from? And they say, I bought a picture of a monkey as an NFT, a couple of years ago, and I've just sold that now. So you can actually request the wallet address, and we have tools now that can unpick complex NFT transactions that allow you to then vet and prove that story is real.
I mean, ultimately, what you're outlining there is quite an evolution of probably today's compliance processes and frameworks. Obviously, now also looking a bit at Tobias, there's quite a lot of new skills that seem to be required in the future financial world, especially when we now think that probably also traditional assets will be dealt via DLT in the future. It seems to start, as you've just outlined, Amardeep, at the point of the client onboarding with first of all identifying source of wealth, source of income, and so on, and then go over or continue at the point where actual funds are transferred into a bank in Tobias's case, or also other financial institutions. So quite interesting. Now, maybe another point that was also mentioned by Julian before is the growing requirements also when it comes to identifying the originator and also the beneficiary of transfers. When you think again about asset transfers, here maybe the one word to think about is the FATF travel rule. Maybe also directed towards both of you, is that something which is giving you a little bit of a headache to fulfill all these requirements, to store, to then also share information? Or would you say these requirements can easily be met? Maybe Tobias first.
Yeah, this obviously, when we drew up the process with SEPA Bank, the sub-custodian, on delivery in and out, we had to bear in mind the FATF travel rule, of course. We technically, this is indeed challenging to implement. Therefore, we mutually agreed on an off-chain process for the time being. We have also restricted this also at the very moment to, on the one hand, of course, existing clients, so only existing clients who have a bank relationship with us already are allowed to deliver in and deliver out digital assets, currently limited to 14 coins tokens, which we have on the trading and custody side in offer. We also only accept transfer-ins from distinct and selected exchanges, so not from everywhere. That's also a further restriction. And we have also two separated processes from, as I said, from accepting from those exchanges versus from private wallets. So on private wallets, the process is a little bit more complex. And we also do not allow a change of beneficial owner for the time being. So there are some limitations, restrictions in there. And as said, as integral part of the delivery process, integrated into this process is a cryptofforensics. So whenever there is, let's say a red flag coming up, being raised either by us or by our sub-custodian, then the delivery is, of course, not accepted. For example, if there is a sanctions nexus, which we already had, given that we, of course, had to prevent circumventing the sanctions regime via the crypto space, then we can immediately stop the delivery process if we come to the conclusion that there is some sort of taintedness, some negativity, some increased risks emerging. Both parties can immediately stop the delivery process.
Okay. Interesting. Well, obviously, we have now seen, Amardeep, a little bit that parts of your solution, of course, cover the forensic analysis where you get a risk scoring for certain transactions and also wallets. Now, is, for instance, then also maybe providing a technical solution for the exchange of information between one digital asset service provider and another to fulfill add-on requirements linked to the FATF travel rule. Is that some sort of natural evolution where you also see the industry, or if not the industry, Chainalysis going?
Yeah, it's a really interesting question, actually. And I think, you know, from an ecosystem perspective, where the industry is heading, I think, you know, the challenge, I think Tobias touched on it there, was the fact that in the TradFi space, you have a bank speaking to a bank. Yes, their internal technology stacks are going to be very different, but the information is there, right? You've got someone that's got a bank account, they've been onboarded, they have KYC details. The fundamental difference when it comes to digital assets is obviously this whole issue with unhosted or private wallets, like Tobias said, right? So this is something that isn't really seen at all in the TradFi, you know, traditional banking space, and therefore there are technological kind of challenges that need to be overcome. That being said, we as Chainalysis, you know, we fundamentally want to be the best at, you know, basically providing on-chain, you know, data and clarifications, right? So at the moment, we're not looking to kind of ourselves go into the off-chain space. And what I mean by that is, you know, the adverse media checks, the travel rule sharing and so forth. What we are looking at is obviously the partnerships that we you know have with you know certain businesses that do offer that you know that capability, and I think that's where, you know, we will probably get the strongest solution is people that are best at their part of that kind of technology coming together and providing a robust solution for banks, you know, and crypto native businesses like exchanges.
Okay, interesting. Now we've talked a lot about asset transfers. Now let's also switch over to custody real quick. We've heard operational risks about custody also in Julian's presentation before. Well, how do you handle those, Tobias? And maybe also what do you see as part of the most important features when you also consider upcoming regulations such as the Markets in Crypto Assets Directive, maybe also, for instance, the Basel Committee's proposals on prudential treatment of crypto assets?
Yeah, I think the measures, as already outlined, to address those operational risks are again performing regular on-site due diligence reviews, regular visits, have regular reviews of the contractual framework. That's crucial because this is something which in other relationships is often not forgotten, but a little bit, let's say, neglected, I would say. So really keep up to date your contractual framework with the sub-custodian or with your digital asset service provider. That's very crucial. This is also something, by the way, which auditors more and more look into, right? So if you have a brokerage agreement or a custody agreement which is 20 years old with your main custodian, you get in big trouble nowadays. So really establish their processes to review that on an ongoing basis. If there are regulatory developments, as said, from Basel, for example, from the BIS, or also upcoming regulatory requirements like the MiCA, then analyze those requirements at a very early stage and prepare yourselves because the market, as you see now, given the FTX debacle and those are the challenges around Binance and stuff, the market is now really urging or asking for doing business in a regulated environment. Therefore, this is a competitive advantage to early adopt those regulatory requirements, to consider those, of course, from a client's perspective, to implement them as smooth, efficient, and effective as possible. That's also important. You know, if there is still a lot of paper trail going back and forth between the client and the bank, you know, this is not state of the art, and those are not well received nor accepted anymore. So this is also something to bear in mind, and also have an open dialogue and regular exchange with your regulator. So FINMA is quite positive and approachable on that, and they have a mutual interest also if you collaborate and cooperate with crypto banks or service providers in the crypto industry, that they know exactly what you are doing with them and how you are doing it, and then just integrate it into your traditional processes. So a broker also needs to be reviewed regularly, a custodian anyway. So this is really crucial, and understand the residual risks. As said, the key risk management is very key here. So understand these procedures, look into them, visit them together with your information security colleagues. That's highly crucial. So by the way, we also could learn from our sub-custodian, because some of the information security protocols they adopted, they were more state of the art, or at least considered by our head in information security as more state of the art as ours, and then we adopted. So we also learn from them. So it's not it's a bilateral learning curve. The same we also learned, by the way, from the crypto forensic providers like Chain Analysis. You know, their approach, their methodology, their philosophy to evaluate and assess and score risks, which is very relevant and interesting to us as well.
Nice. Well, I mean, also, you know, when it comes to that, probably the market is evolving. There is new industry standards evolving. I guess in the beginning, when you had tools like Chainalysis, it was very much focused on one chain, whereas today you also see more and more cross-chain analytics and so on. So quite interesting. Maybe to close off, and now also switching over to Amardeep once again, you being in contact with so many different industry players from the financial institution, what is the one hint you can give to interested financial institutions that maybe have not yet started their endeavor in digital assets? Yeah.
Yeah, no, really good question. And I think, you know, observing kind of the ecosystem right now, I think the majority of banks do have it on their radar, as do other financial institutions, including, you know, money service businesses and also kind of payment processors. I think there is, you know, a lot of opportunity that you know we've been discussing over the past few years around creation of stable coins, for example, where there's a gap, understanding the market and the ecosystem and seeing whether or not there's significant opportunity there, which typically there is. And so I would say that, you know, what we observe with a lot of the financial institutions that we work with is, you know, you cannot just turn on crypto assets or digital assets as a service or a product, right? This is a true journey, right? You've heard from everybody today. Tobias has highlighted, you know, all of the different considerations that you need to take, you know, in. And I would say when it comes to that journey, you are talking about a significant amount of time. But what we like to do as a, you know, with our kind of, you know, years of experience in this industry is really just break that down for you. So it kind of, you know, is manageable. And we have something that we have created called the maturity model index. And this just takes you through kind of your journey and how to break down that. So, you know, at the early stages, what you need to do is understand what kind of products you want to offer, the opportunity. And then also, so you have the commercial side of the business, and that comes together with the enterprise risk side of the business. So you have both the commercial side and aspects and the opportunity, but then you have, okay, well, what additional risk based approaches and risk mitigation strategies are we going to need to really make sure that we develop that in a safe and compliant manner. So once you've got that core team developed, you can then start kind of on your journey, and you know, I think that's where we see the biggest success stories really is that real kind of, you know, to a certain extent, belief as well that this is actually a really good opportunity for us to explore and to take it seriously and really kind of, you know, have that core team built out to start off your journey. And training obviously is a huge element of that. I think, you know, I've been in digital assets for probably, well, since 2013 to, you know, so a number of years, and you know, you learn things every day. It's not a case of, you know, a slow moving ecosystem or industry. There's new advancements, new risks, new opportunity coming up every single day, and it's really about the education, I think, that underpins it. So, you know, we provide a robust kind of online academy and training and certification program as well that helps you in your journey.
All right. Well, maybe to close off finally, just by each of you, a one-sentence statement about DLT risk and risk management. What would that be?
Yeah, I would just echo. It's a journey. Be prepared. Regulation lacks the market development. This is also something you have to bear in mind and to accept to some extent. So be open to shape the regulation also with the regulators if you enter that market, because it really lacks. I just had a meeting today with Deutsche Börse and Crypto Finance. You know, when they approach BaFin on various questions on how to do set up ETD clearing in the crypto space, you know, there is no regulatory framework around that. So be really open and consider that as well. And it's a journey, and also the risk framework evolves together with your offering, with the regulatory developments and the market participants.
Okay, well, thank you.
And yeah, just to echo, really, I would say, you know, I think we're working with many banks and financial institutions. I think they really do see the opportunity, and I think that is really coming from the, you know, the global regulatory clarity that is emerging now when it comes to regulatory frameworks and so forth. We are no longer in those early days. There is significant development, as we've touched on. There is kind of, you know, MiCA that's going to handle the single market. You've got FCA taking it seriously in the UK, for instance, a big push over in the UAE, where I'm situated at the moment. So, you know, you've got a lot of movement when it comes to regulatory frameworks and legislation coming out in the next year or so. So I would just say, don't be late to the party, because obviously these things do take time. And so, you know, you don't want to be starting your journey when there is full regulatory clarity and half the market's already moved, you know, on.
All right, thanks a lot, everybody. We are slightly over the time now. Thanks to you, Amardeep and Tobias, for these very interesting insights. I keep the word journey in mind. I think should everybody else. Also, thanks to Andrew, who spoke before. And I'm sparing now a summary. I think it was a lot of details provided. The journey will go on, discussions will go on. And with that, I wish you all a very nice rest of the day. And as we say in Switzerland, gute. Take care.
Thank you.
Bye.
Thank you.
Thank you.
Ciao.
Thank you.
Bye-bye.
Ciao.
Thanks, everyone. Bye now.